Hello everyone. In this video I'm going to cover chapter 5 of the financial accounting course, and chapter 5 basically covers the last few steps of the accounting cycle. So we call the last few steps closing entries. So closing entries. Before I start with the closing entries, let's just remember the accounting cycle's steps. So the accounting cycle, it starts with journalizing, where we capture economic events using the accounting language. And number 2, we post those journalized entries, post entries to the ledger, or in other words, the account or the accounts. And number 3, we prepare a trial balance where we should have debits and credits with equal amounts. Number 4, we adjust our entries, adjusting entries, which take place at the very last day of the financial cycle, adjusting entries. Using those adjusting entries and applying them to the trial balance, we get an adjusted trial balance. Adjusted trial balance. In number 6, we prepare the 3 main financial statements, prepare the balance sheet, income statement, and cash flow statement. Of course, those are prepared using the adjusted trial balance. In number 7, we prepare the closing entries. So closing entries is number 7. Closing entries. And number 8, we should have the after closing trial balance. So just to remind you, the first 3 steps were covered in chapter 3. The adjusting entries and the adjusted trial balance were covered in chapter 4. The last 3 steps are covered in chapter 5. Of course, throughout the chapters so far, we've introduced how to prepare a balance sheet. Just to remind you that a balance sheet should have a specific date, so as at December 31, 2020. It has 3 categories: assets, liabilities, and owner's equity. The main components under assets usually are cash, account receivable, notes receivable, inventory, supplies, equipment, buildings, land. And we said that we list them in the descending order of maturity. Sorry, not maturity, liquidity. Maturity refers to liabilities. Liquidity. Okay. As for liabilities, we have accounts payable, notes payable, salaries payable, interest payable, tax payable. We might also have something like a bank loan, which we call long-term debt, bank loan. Liabilities are listed in the descending order of maturity. So this will be paid in the near future, and this will be paid after several years. Owner's equity, we know that it has 2 main components: capital stock and retained earnings. This is the initial contribution of investors, and this is the accumulation of profits over the accounting cycles. I'd like to introduce a couple of additional concepts where we have something called current assets, and those current assets are assets that are expected to be converted into cash in the short run. Okay, so current assets, or CA. Usually they include cash, receivables, and inventory. As for liabilities, we have current liabilities, and they are the liabilities, so current liabilities, or CL, and CL are liabilities that are expected to be paid in the short run. Usually, when we want to assess whether a company has good liquidity or not, we compare current assets to current liabilities. So if current assets are greater than current liabilities, then we're doing okay in terms of liquidity. Okay, so those are current assets, this list, and we have fixed assets, which are usually not expected to be converted into cash in the short period. The same happens in liabilities, where we have current liabilities and we have something called long-term debt. Okay, and usually this is a bank loan that will be paid after several years or over several years. Okay, so current assets versus current liabilities, and current assets versus fixed assets, current liabilities versus long-term debt. This is the structure and some information about the balance sheet that teaches us how to, or explains how to assess liquidity. If we want to assess profitability, we would assess the change in retained earnings from one year to another. So retained earnings in year T, or let's say T plus 1, minus the retained earnings in year T is the profit generated from year T to year T plus 1. Of course, excluding the dividends that were distributed on shareholders. So if the change, this is the change, if change from year T to year T plus 1 is positive, then the company is profitable. Okay? So this is how we can assess liquidity and profitability from the balance sheet. As for the income statement, so the income statement, it covers an interval of time. So we say from the beginning of Jan 2020 to the end of December 2020. And again, if we have a merchandising company, it will have a different structure of the income statement compared to a service company. In previous chapters, I covered this. However, today I'm going to introduce a few additional expenses. For example, in a merchandising company, you might have sales revenue minus the cost of goods sold. You will get gross profit. Then you will take out other expenses. Those other expenses can be several ones. Let's say depreciation expense. A depreciation expense is simply an expense that the company incurs when an asset loses from its value. So when let's say you purchased a car, and this car, after 1 year, it lost from its value $2,000 approximately. So your depreciation expense for the car over this year is $2,000. Depreciation expense, utilities expense, rent expense, anything can be an expense, salaries expense, interest expense. So when you have a bank loan or a note payable, the interest that you pay to the bank or to the issuer of the note, to the holder of the note, is called an interest expense, and it appears here. In the balance sheet, you don't see it as a number. It is reflected in the retained earnings, of course, but it doesn't appear as a number. After deducting all of these, you will reach the income before taxes. This number, usually, you deduct from it a tax percentage that is specified by the government. So the government specifies the percentage that should be applied on this income before tax, and eventually you reach the net income. Okay? So assume this is $100,000 and the tax percentage is 0.3, so 30%, the net income will be $70,000. Okay, this is just an example to elaborate. As for the services company, you have service revenue minus other expenses right away. Those other expenses can be several ones. Depreciation is one of them. Utilities, rent, salaries, wages, interest, and so on. You get income before taxes. Then you deduct taxes as a percentage, and you will end up with net income again. Okay? So the point here is that in both cases, you deduct all expenses from your revenues, and then you apply the tax percentage. This is why in some companies you see that they might increase their expenses deliberately on purpose so that they pay lower taxes. Anyway, this is the income statement and how we prepare an income statement. The statement of cash flows, we will leave it till chapter 13. Just to remind you that the statement of cash flows has three parts: cash flow from operating activities, and those are the day-to-day operations; cash flow from financing activities, when you take a loan, when you pay a dividend; and finally cash flow from investing activities. Okay, this is everything you need to know about the three financial statements. Now, so here, knowing those three financial statements basically covers part 6. As for the rest, part 7, the closing entries. Before starting or introducing the closing entries, let me first define two types of accounts. Accounts are categorized into two types. The first type is a temporary account, and as you'd expect, the other type is a permanent account. A permanent account, it carries its balances or its balance from one accounting period to another. Unlike temporary accounts, the permanent accounts include it includes permanent accounts. Let's say assets, liabilities, owner's equity, all these normal accounts, they are called permanent accounts. So they carry their value from one cycle to another. Cash, retained earnings, land, accounts receivable, and there is a very long list of permanent accounts. Temporary accounts, on the other hand, temporary accounts, they should have a balance of 0 at the beginning of each accounting period or cycle. So we need to apply the accounting procedure that will set this temporary account or these temporary accounts back to 0 at the beginning of each accounting period. So they start from scratch. Temporary accounts include revenues, expenses, and dividends. Revenues, expenses, and dividends. All other accounts are considered permanent accounts. If you think about it, at the end of each accounting cycle, you should start with a 0 revenue, 0 expense, and 0 dividends. And then you will start making sales or providing services to earn some revenues, and receiving services and purchasing inventory before selling them so that you can incur expenses and costs. And then you distribute dividends. So revenues, expenses, and dividends are separate for each accounting period or cycle. Therefore, at the end of each accounting cycle or period, you should set those back to 0 so that you start from scratch at the beginning of each accounting period. Okay, so temporary accounts versus permanent accounts. If we go back to the accounting cycle, when you adjust the trial balance and prepare the three financial statements, the three main financial statements, you usually do this at the end of the period, the accounting period. So you want to start a new accounting period, therefore you need to close your entries and set the temporary accounts back to 0. Accordingly, the closing entries which is the title of the chapter, you set all temporary accounts back to 0 at the end of the accounting cycle, and between parentheses after preparing the main financial statements In doing so, you transfer the profit or loss which is in the income statement to retained earnings in the balance sheet, so to the balance sheet under retained earnings, and pay dividends to shareholders. This is what the closing entries are supposed to do. Okay. The steps of the closing entries. There are 4 steps: 1, 2, 3, and 4. In step 1, we close revenues to a new temporary account that we open at the beginning of the closing entries and close it at the end of the closing entries. This temporary account is called income summary. To income summary. Basically, income summary is simply an account that will hold the net income. So income summary, as a definition, it's a new temporary account, a new temporary account that hosts revenues and expenses then transfer the balance, not them, the balance, and the balance is basically revenues minus expenses, which is the net income. The balance, which is the net income, to retained earnings. Okay, so you close revenues to income summary, then you close expenses to income summary. Usually we refer to income summary as IS. In the third step, we close the balance in the income summary in IS to retained earnings. So now the balance of revenues minus expenses is transferred to retained earnings. So in this step, step 3, we added the profit of the company to retained earnings. In the last step, we pay dividends. So we close dividends to retained earnings. Okay, those are the 4 steps in which we set revenues back to 0, set expenses back to 0, close income summary to retained earnings. So here you are closing the income summary account. It's getting back to 0 as well. So it's born in step 1 and it dies in step 3. And finally, we are setting dividends back to 0. Now, those 4 steps, they are done using accounting transactions. Okay? So let me tell you how to do this in accounting. You need to keep in mind that revenues initially. So step number 1. Before doing that, let me put the T accounts just to demonstrate how things work. Okay, those are the 4 accounts, and let's say 5 accounts of revenues, expenses, what else do we have? Income summary, retained earnings, and dividends. Okay. Initially, you have a balance in the revenues. Let's say we have in the revenues to $20,000. And you know that revenues always have a credit balance. Expenses, we have $15,000. And we also know that expenses always have a debit balance. We know that, the given says that you already have $150,000 in retained earnings, and your dividends have a balance of $1,000. Okay. Now, we need to set back this one, and this one back to 0. In step number 1, when we close revenues to income summary, we need to get this back to zero. It's a credit balance, so we need to put it on the debit. So we debit revenues and we transfer this value to the income summary, which we open just to host revenues and expenses. If revenues is on the debit, because we want to get it to zero, back to zero, then income summary will be on the credit. So $20,000, $20,000. So here you will have a $20,000, and here you will have a $20,000. So this is a zero now. Revenues are set back to zero. Expenses in step 2. Set expenses back to zero. Expenses usually have a debit balance, so you need to credit them. So expenses are on the credit. And therefore, income summary is on the debit. The value is $15,000. $15,000. So now if you have a credit in expenses $15,000, then it's back to zero as well. We're done with expenses. And this value is transferred to the income summary. So the income summary now has a balance of $5,000 on the credit side. Therefore, my net income, which is revenues minus expenses, is $5,000. Okay? Now, those $5,000 need to be transferred to retained earnings so that we can set this account back to zero. So in step 3, if the income summary has a credit balance of $5,000, then I should debit it so that I set it back to zero. Debit income summary by $5,000 and I'm transferring it to retained earnings. So retained earnings will have a balance of $5,000 on the credit. So now this is a $5,000 for income summary, and therefore it's set back to zero. Now I'm done with income summary. This value will be transferred to retained earnings on the credit. So retained earnings now has a value of $155,000 that will appear in the balance sheet. Finally, I have dividends. I need to offset dividends or set them back to zero. In the 4th step, I pay dividends. How do I do this? By crediting dividends so that I have the $1,000 on the empty side so that I set it back to zero. So this is a credit dividends for $1,000. I'm closing dividends to retained earnings as if I'm paying from retained earnings. So my retained earnings on the debit by $1,000. Now, if you put $1,000 over here in dividends, then the balance is zero and you're done with dividends. If you put $1,000 here in retained earnings, therefore on the debit side, you will end up with a balance of $154,000. And this is the value of retained earnings that appears in the balance sheet. So this is how we close our accounting cycle. You close revenues to income summary, expenses to income summary, retained earnings to income summary, income summary to retained earnings, and finally dividends to retained earnings. And this is how we close the accounting cycle. After the closing trial balance, which is the 8th step, all revenues, expenses, and dividends should have a zero balance again, so that we can start a new accounting period with those temporary accounts having zero balances. One last concept or a mini statement that I want to introduce is called the statement of retained earnings. So this is a small statement of retained earnings. The statement is based on a very simple concept. It says that new retained earnings, or let me call them ending retained earnings at the end of the cycle, the earnings are equal to the beginning retained earnings. Add to it whatever you generated as net income, less all dividends that were paid or distributed among shareholders. So the beginning balance of retained earnings plus the profit that you generated throughout the year or the cycle minus the dividends that were paid to shareholders, you will end up with the retained earnings at the end of the year. Now, the example says, during the year, ABC Incorporation generated $1,200,000 in revenues and incurred $800,000 in expenses. The CFO, the Chief Financial Officer, decided to pay shareholders $250,000 in dividends. At the beginning of the year, the company had a retained earnings balance of $15,850,000. The first question asks us, prepare a statement of retained earnings, part B, post closing entries. The solution is very simple. Part A says that the ending, this is the statement of retained earnings. So let me say, to prepare it properly, ABC Incorporation. The title of the financial statement is Statement of Retained Earnings from, let's say, the beginning of 2020 till or to the end of December 2020. And then you start by saying that retained earnings on the beginning of Jan 2020 are equal to $15,850,000. Add or plus net income generated during the year. So from the beginning of Jan to the end of December of that year, the net income is the revenues minus the expenses. So 1,200,000 minus 800,000 is a $400,000 less the dividends paid, which is a value of $250,000. Again, I always remind you that negative numbers in accounting are placed within brackets. This will get us the retained earnings at the end of the cycle, which is dated 31st of December 2020, and the value will be $16 million. Okay, this is everything about the statement of retained earnings. As for the closing entries, the closing entries are straightforward. We have 4 closing entries. So in the first one, we close revenues to income summary. So revenues usually have a credit balance. Now we debit them. So you will have revenues $1,200,000 and income summary with the same value. In step 2, we close expenses to the income summary. Expenses usually have a debit account balance, so that we are able to close it back to zero. We should credit them. So expenses, for the first time, you see them on the credit, and the value is $800,000. And here you are closing it to income summary, $800,000. Now, if you think about it, the income summary now has $1,200,000 on the credit and $800,000 on the debit. So the balance now is $400,000 on the credit. To close this, in step 3, you will close the income summary to retained earnings. How to do that? You need to get rid of this number, so you need to debit it. So debit income summary and credit retained earnings, 400,000. So now if you do this 400,000, you will have a balance of a 0, and therefore the income summary, the temporary account, is set back to 0, just like the expenses and revenues. In the 4th step, you will close the dividends to be paid or paid to shareholders to retained earnings. Dividends usually are just like expenses. They have a debit account. You need to credit them. So credit dividends and debit retained earnings, and the value is $250,000. So basically, if you think about it in a simple way, you added to retained earnings 400,000 and you deducted 250,000, because retained earnings are just like any item under owner's equity. They increase by credit. So here we added 400,000 and deducted 250,000. Therefore, in total, in net, we added to retained earnings the difference, which is 150,000, which is the increase in retained earnings from $15,850,000 to $16 million. This is the end of the chapter. I'll see you in a new